The first futures exchange. In 1697, the Dojima Rice Exchange was established in Osaka, Japan. It is considered the first organized futures trading platform. It originated thanks to landowners. Their main source of income was the farming and sale of rice. Farmers made money by selling warehouse receipts for rice and transferred excess supplies to Osaka and Edo. Merchants who bought such receipts soon began lending money to farmers in need in return for future rice crops. In 1730, futures trading began on the Dojima market with the goal of preventing a long-term decline in rice prices. This allowed farmers to hedge against price changes between harvests. The Dojima Rice futures market operated according to all the rules of modern futures trading. There was a fixed volume for each contract and clear deadlines for its expiration. The spring contract was from January 8th until April 28th, the summer contract was from May 7th until October 9th, and the winter contract was from October 17th until December 24th. All transactions were entered into a book registration system, where the names of the parties, rice volumes, futures prices, and delivery dates were recorded. The transactions were settled in cash without obligation to physically deliver the rice at the end of the trading period. This is how rice contract trading started in Japan in the middle of the 18th century. A century later, in the 1850s, grain and livestock contracts appeared in America. Later, they were joined by energy and metal futures. But the truly revolutionary and groundbreaking event was the introduction of derivatives on financial assets.